It's time now for Mortgage Matters with your host, Bill Sandvig. Bill Sandvig serves as market leader running the South Carolina coast for Movement Mortgage. Movement finished 2014 ranked as the #1 mortgage company in purchase mortgages for the Charleston Tri-County area. And they're still growing. And now your host of Mortgage Matters, Bill Sandvig.
Hello, Charleston. It is great to be here with you guys. And if you're listening right now, you are listening to history. This is the very first Mortgage Matters show in the Charleston Low Country. And maybe that's a little bit dramatic, but hey, I'm excited to be here. And I'm excited to be talking to you guys about mortgage, finance, and real estate. I've got with me today Nick Pavia. Nick is with Commonwealth Financial Group. Hello, Nick.
Hey, good to be here today, Bill.
And we're going to be talking about over the next every week we'll be here at the same time talking about mortgages, talking about finance, talking about real estate. And we encourage any of you to call in and ask us any questions you have about any of those topics. Call in anytime. It's 843-556-1250. So I want to start the show off, Nick, talking about, interest rates. Right? So that's the most common question I get in my work day, all day, every day, is what are interest rates? And according to USA Today, the mortgage interest rates, average mortgage rates for this week were at, on the 30-year fixed, 3.78%. Now, that is ridiculously low.
Unbelievable.
Unbelievably low. This time last year, the average 30-year rate was at 4.32, according to USA Today. And nobody thought this time last year that we'd be talking about having 30-year fixed rates 0.5% lower now than they were last year. Everyone has been talking about rates going up, and everyone's still talking about rates going up. And now I want to talk a little bit about why interest rates are where they are right now. The Federal Reserve has been holding down short-term bonds and short-term interest rates artificially low for the last 5 or 6 years. This is what's been keeping those interest rates at historically low levels for such a long time. And right now, everyone is projecting that interest rates are going to be heading up. Everyone is talking about it. Actually, we had a huge meeting. The Federal Reserve met, and Janet Yellen came out this week, and we're all wondering when are rates going to start going up. Well, Janet said this week when she came out and addressed the nation that the Fed is not in a hurry. They're not in a hurry to have rates going up because they don't want to have what has been incredible growth in the real estate market and the housing market across the country. They do not want that to stall. Right. They want to see houses selling. They want to see the markets hot. They want to see people buying homes, getting into homes. And the last thing that they're going to do is have interest rates jump at the expense of the housing market. The housing market is way too important and way too valuable to the entire health of the economy, the entire country, to run any kind of risk. So what Janet said this week is they're going to continue to be patient. They're going to continue to be patient with rates. They're going to continue to be patient about raising those short-term notes and allow for interest rates to hold off on the increase and stay low for a little bit longer. That's the question. How long is a little bit longer?
Well, what we've seen in our work, and just to backtrack a little bit, I'm a financial advisor at Commonwealth Financial Group, is that interest rates have been held artificially low by the Fed for 5, 6, 7, 8 years, essentially since the recession in 2008, and it's just no one thought that the rates would be as low as they are for as long as they are, right? And they have to adjust eventually.
They've got to go up, and everyone is expecting that this is the last year. This is the last year of the Cinderella time where you're going to see interest rates below 4%. If at some point they are going to allow for rates to go up, and everybody is expecting that time is going to be this year. So if you're out there and you're thinking about buying a house, the time is now. If you're thinking about refinancing, if you've been holding off thinking that rates might fall from 4% to 3.5%, stop waiting, because there is too little upside for waiting. If rates get better, we're going to be talking about them getting better by 1/8%. If rates get worse, we're going to be talking about them getting worse by 1%, by 1.5%, by 2%. So stop waiting. If you have any questions for me anytime at all, you can call in at 843-556-1250. We're going to be taking calls the entire hour, and we are here to answer any questions you have about mortgages, real estate, and finance. And if you want to reach me personally, you can reach me at 843-300-7870, or you can go to my website at lowcountrylending.com. And you can reach Nick at his website, www.commonwealthfg.com. And Nick, what's another way to reach you?
Yeah, you can reach me on my direct line, which is 843-819-3949. And Bill, to your point, rates have been artificially held low for a long time. We know they're going to adjust. There's a lot of things that play into that. I think you may see them held low through this current president's tenure, right? And then maybe adjust after that. But if you're thinking about buying a home or maybe refinancing, now is the time you have to act, because it's a ticking time bomb. Once they do adjust, we think that may be the triggering factor for the economy to shift, right, as a whole. And if you look historically, rates have been as low as they have ever been, certainly in our lifetimes, right? And so why not take advantage of this opportunity now?
Oh, yeah, without question. I mean, when we talk about interest rates and housing prices, the cost of housing, or what we refer to as the housing affordability index, it has never been lower. There might be a period in time, maybe 6 months, about a year and a half ago, where the real estate market had hit rock bottom. Housing prices were as low as they were going to be, and interest rates were still down. The housing affordability index is basically, it's how much of your mortgage payment compared to your amount of income. So it's just an index factor about how expensive is it for you to be inside the house that you want. The two main driving factors for that are interest rates, which drive your mortgage.
Absolutely.
And the cost of the home.
Absolutely.
So 2 years ago, that number hit the lowest it had ever been in history. And we didn't want it to get any worse. Because if it got worse, that means the economy wasn't turning around, housing prices were still falling, and even low interest rates weren't going to fix it.
Right.
So we've seen recovery. We've seen housing prices starting to go up, and they've been going up very strong, especially here in the Low Country. Very steady increases for the last 2 years, but interest rates stay down. So if you're thinking about buying a house, if you're thinking about getting a mortgage, now's the time. A $200,000 home right now, if interest rates go up 1% and the real estate market continues to improve in the Low Country, and we have another 6 or 7% increase in home values from this time to next year, well, that exact same house could cost you another $150 a month in payment. The exact
Easy.
same house for the exact same amount of money down,
right,
just because interest rates go up. And I talk to so many customers who are just on the fence about, do I want to buy now? Do I want to sign another year lease? I like this house, but I'm not sure if I want to pull the trigger. And I just hate to see when they're looking at a house point and this is what their budget is, and their income isn't going to increase to change that budget, and the market changes, and now instead of looking at a hypothetical $200,000 house, they're looking at a $170,000 house, and or they have to cut back on bedrooms, they have to cut back on something. The time to buy is now. We can't really stress that enough. And when you're thinking about buying, think about going local. You got to use local companies, local people, local advisors who know the market, know the local market, know the local industry. I can't stress that enough. It's so important to have people like myself, people like Nick. We have other partners who are going to be a part of this program that you'll be hearing from week to week. Jimmy Foti of Foti Law. If you want to see anything about him, you can go to FotiLawFirm.com. He's a local real estate attorney. He's the owner of his company and someone who's going to be there to answer questions. Another PNC partner of mine, Andrew Muller of Mappus Insurance. Andrew's the owner and president of Mappus Insurance, a local insurance agency, and he's going to be here. Partners like that make a difference for you when you're trying to make a home purchase. So I'll continue to encourage people to call in to us here at 1250 WTMA, the Big Talker, 556-1250. That's 556-1250. I encourage anyone to call. We want to talk to you about mortgages, finance. I've got Nick, a certified financial advisor right here, financial planner, and he's happy to address any questions you might have about any topic. We encourage you to call in and try and stump us. So one of the couple topics I want to talk about in future segments is why you want a mortgage. Why you want a mortgage right now. We're also going to talk about what happens after the mortgage. So now you've gotten a mortgage, what happens then? And the other most common question, you're a first-time home buyer, how do I get a mortgage? We're going to talk about all those things. And the answer to that first question, why do you want a mortgage? It starts with interest rates. Interest rates are so good right now. They're so low, so strong that it's time to have a mortgage. You think back to maybe your parents or your grandparents and that philosophy of buy your home, get the 30-year mortgage, pay the mortgage every month for 30 years, get rid of the mortgage, and that's the accomplishment, that's the achievement, is to get rid of that mortgage and not have a mortgage payment going into retirement. Well, that time is over. That's not how it works these days, especially when interest rates are this low. When interest rates were 18%, 15%, 11%, 25 years ago, avoiding a mortgage would have been a smart move. You don't want to be paying that kind of principal on such a large debt. But with rates so low, with where they are right now, it's not necessarily a bad thing to have a large mortgage.
Right.
I mean, think about it. The average rate of inflation in our country's history is somewhere around, I believe, 3.3%. Yeah. Yep. So 3.3%.
That's right.
The average rate of inflation. If you look over any period in time, a 30-year period, the standard length of a mortgage, that average inflation is probably going to come true in any large time period like that. So think about this. That means the value of your dollar sitting under your mattress goes up 3.3% every year. Well, it just so happens that right now you can lock in a mortgage for 30 years at USA Today's average rate of 3.78%.
Right.
3.87%. And now that mortgage is tax-free money, right? The interest you pay on your mortgage is tax-free. You can write that off. So now if we say we have an equivalent interest rate after we factor in the tax savings of maybe even 3%, even if you're in a conservative tax bracket, but less than 3%.
Right.
So your money in your mortgage is actually growing slower than the average rate of inflation.
Right, exactly. And those dollars are all locked up in your house, right? And so you're limiting yourself from a standpoint as far as future investments. You know, if you put a huge down payment on your house, more than 20% that's recommended, right? You're in a situation where every extra dollar you put in, you're really limiting yourself both from an investment standpoint, whether that be in the stock market or whatever, or future opportunities, such as if you maybe want to open a business or whatever it may be. And so you need to really look at your situation, not only from, hey, what's the market doing right now and the economy doing right now, but what is it doing 10 years from now and 20 years from now and 30 years from now? It doesn't move, and you're the mortgage expert, you tell me, it doesn't really move the needle that much on your interest rate when you go from putting, 10 to 15 to 20, then beyond 20% down, if I'm correct, right?
Yeah, Nick, thank you. That's a great segue. I want to tap into this a little bit more. I want to talk about things we can do with our money other than putting it down on a house, other than putting it into equity in your home. Maybe some smarter things to do right now and take advantage of these low interest rates when we get back. This is Mortgage Matters with Bill Sandvig on WTMA 1250, The Big Talker.
There's more Mortgage Matters with Bill Sandvig coming up next on The Big Talker, 1250 WTMA. WTMA. You're listening to Mortgage Matters on 1250 WTMA. Once again, here's Movement Mortgage's Bill Sandvig.
Welcome back, Charleston. We are talking about why you need a mortgage. We're talking about low interest rates and how you can be smarter with your equity in your house. And if you have any questions for us at all, please give us a call on 1250 WTMA, The Big Talker, at 556-1250. That's 556-1250. And you can reach me personally at 843-300-7870, or go to my website at www.billsandvig.com. lowcountrylending.com. I'll be happy to address any questions during the show, after the show. Please give me a call. I'd love to talk about mortgages, love to talk about finance, love to talk about real estate. I've got Nick Pavia here with me right now with Commonwealth Financial Group, and we are talking about why you need a mortgage. Now, interest rates are very low. They are relatively lower than they've ever been in history. We don't know how much longer that's going to last. We know that it's ticking clock. It's not going to last forever. And what we want to talk about today is you might be sitting there with a whole bunch of equity in your house. You might be thinking about moving down here from out of town, or you're thinking about downsizing or upsizing, and you've got some equity in your house, or you've got some money in the bank. What do you do with that money? Well, there's a limit on, and Nick alluded to this right when we went into break, there's a limit to what impact that money will have on your interest rate.
Right.
If you have strong credit, decent credit, once you've put down around 20 or 25% in your house and you're avoiding mortgage insurance, that's always the first goal when you're getting a mortgage, is trying to get away from mortgage insurance. And that happens anytime you've put down 20%. Well, at some point, the interest rate's not going to really improve. Right. You're getting the top tier rate, your credit's there, you're putting the money down in the house, going from 20% down to 50% down isn't going to help you get a better interest rate.
Right.
So as long as you can qualify for that higher payment, there are so many other things to do with that money. We talked about how right now you have the ability, everyone has the ability to lock in somewhere below a sub 4% 30-year fixed interest rate.
Which is remarkable.
I mean, and so we're talking about interest rates below 4%, and we touched on the average rate of inflation in the country historically is 3.3%. So 4% interest rate for 30 years, that interest is tax-free. Now, we're going to say that tax-free means you save about 25 cents on the dollar on that interest on your taxes. Well, now we have an effective interest rate. I'm not going to do specific math, but for easy math, an effective interest rate of somewhere around 3%.
Right.
So you have the ability to lock in an interest rate on your mortgage less than the average rate of inflation. What that means, if you're listening out there, is that you could theoretically take a cash out refinance on your house. If you had $200,000 in available equity, take that $200,000 on a fixed mortgage, put the money under your mattress, and that money would grow because of inflation in value more than the interest you're trying to avoid. Think about that. Now, I'm not telling you to go and take money out of your house and take a bunch of cash and put it under your mattress. There's a lot smarter things to do with that money, and that's what I want to talk to Nick about.
Right.
But Nick, I mean,
yeah, the thing you need to think about when you're either downsizing, upsizing, buying a new home, and trying to figure out what kind of down payment to put down is, how does that down payment affect the rest of your financial goals, right? And a lot of times clients, or our clients that we talk to, are so focused with putting the largest down payment possible and then paying that house off as quickly as possible, because that was the old school thought process, right? Back when interest rates were 7, 8, 9, 10% on a home purchase, then yeah, sure, that made sense. But nowadays, with interest rates being so low, you have to look at the opportunity cost of what those dollars could be doing for you, whether you invest them in the market, whether you invest them in whatever, business, second property, whatever it may be. And so you really have to look at that. The other thing you need to look at is when you're looking at your home purchase, right? And it's not going to move the needle as far as your interest rates, because they're going from 20 to 30%. You know, you have to really think about, okay, where am I going to be in 10, 15, 20 years from now? Am I going to still be in this house? Number one. Number two is putting those extra dollars into my home where they'll be locked up, going to affect my retirement. Meaning, do I need to invest those dollars to create an income stream for retirement? And so you really need to think beyond that initial purchase. So many people are just so focused on getting into that house, they kind of forget about the big picture, right?
Yeah.
A lot of times, maybe you make some sacrifices along the way. Maybe you liquidate some investments that, maybe you really didn't want to.
Yeah.
Maybe you have to borrow some money from mom and dad to get into that first house. And I'm not saying whether that's good or bad or right or wrong. What I am saying is that you need to think beyond that initial home purchase and how it's going to affect your family's life way down the line.
Now, I want to put you on the spot a little bit here.
Sure.
I mean, you're a financial advisor, and I wouldn't expect for you to just throw out some willy-nilly percentage, but what do you think is a reasonable expectation for someone that's looking for maybe even conservative growth to do with a financial portfolio? I mean, what an average type of return over 10 or 15 years?
Yeah, net of fees, you should be looking at somewhere in the neighborhood of 5, 6, 7, 8%, depending on how aggressive you want to be. Of course, we can't promise that, but historically, if you look at a diversified portfolio, you should shake out in that neighborhood, right?
Sure. So one of the things that people always, I say, instead of putting this $200,000 down in your house, I mean, if you're going to get anything better than a 4% return on this money over the course of time, over the course of this mortgage, it's going to be better somewhere else.
Absolutely.
So now 5% return is a conservative investment, for a diverse portfolio on an average return on your money. If you're not getting that, most financial advisor would say you need to become my client.
Right.
Exactly. So
exactly.
With that being said, I think people get too caught up in the now,
Right.
and people think about, oh, I remember when I had my first mortgage back in the 80s and I was paying 17%, and now interest rates are so great. Well, they also forget that, hey, your checking account was paying you 8%.
Right. And everything's relative.
Right. So everything
so
is
you have to
relative.
understand that.
So right now you have the opportunity to lock in an interest rate relative to now times. Well, if inflation picks up, when the rates go up, which they will, you could be looking at CDs again that are in the 5-6%. Right. You could be looking possibly checking accounts in 20 years could be giving you that 5-6%.
Right.
And if you have a checking account that's giving you 5-6% and your mortgage is still at 4%,
that's a powerful thing.
then you're doing way better.
Absolutely.
Way better. And so you can't just think about what's happening right now. As a consumer, you got to be thinking about what's happened in history. What do these averages look like? What do we think is going to happen? Right. And knowing that right now interest rates are so good, now's the time to use that equity in your house.
Right.
And a lot of you have equity in your house for the first time. Mm-hmm. You've bought your first house and you bought it back in 2005, and now you've been making a mortgage payment for 10 years and you couldn't sell, and now you finally have equity in your house because the housing market's recovered, the values are up. You now have equity in your house. And think about what to do with that equity. I encourage you to talk to a specialist, talk to someone local, talk about what to do with that money, because it's sitting there. And if you had that mortgage because you couldn't refinance because your house was upside down, well, you might even be having a higher interest rate. It's time to think about what to do with your newfound equity. It's time to think about getting away and getting a new interest rate locked in. And the funny thing about this whole conversation for me is, up until the last couple of years, I have always been a proponent of ARM mortgages. I've always thought that doing an ARM and for a 10-year period or a 7-year period was a smart move. Right. Because when you do ARMs, the average time that someone has a mortgage in the country, it's only about 5-6 years.
Right. Before they change houses.
You move, you refinance, you do something that impacts that mortgage.
Right.
And now, of course, falling interest rates have driven that average. Right. We've had a falling interest rates for the last 30 years. And now we might have rising interest rates for the next 30 years. Yep. And so that average is going to naturally go up because we are at a bottom in rates. Right. And so for the first time, I'm feeling like the ARM necessarily isn't the way to go, unless you're not holding on to that house.
It doesn't make sense. And we have clients call us for that advice all the time. And we had a client this week who called me on Wednesday. As a matter of fact, he was like, Nick, I'm thinking about doing a 7-year ARM. I said, why? When you look at what your payment is on the ARM versus a 15-year fixed or a 30-year fixed and your interest rate, after we had talked about it for a few minutes, why would you take the risk on the ARM? Yeah. Right. He's going to be in the house he plans on for longer than 7 years. He thought he could pay it off in 7. Right. Sure. And I was like, well, maybe, but
that ties into exactly what we're talking about. Right? Why pay off your mortgage in 7 years? Why are you going to just dump all that capital?
And the reason why is I said, explain to me your thinking. He's like, well, that's what my parents did. Right. Well, when his parents bought the house, interest rates were, double digits. And we kind of went through that thought process. Right. And then he said, you know what? I need to rethink some of my strategy here, because I've been listening to maybe advice that not necessarily that it's wrong advice. It's just for the time that we're in right now. These are unique times around the low interest rate environment. So you got to take advantage of it.
And you touched really quick on the 15 or the 30-year mortgage. And for the same conversation, I just don't think that it's worth doing a 15-year note right now when all you're doing is trying to save yourself maybe 0.5% in interest rate and getting from below 4% to 3.5%, or 3.25% on a 15-year note, if you can do better than the average mortgage rate that you lock in right now, anywhere else, and we've talked about all the different avenues you can do that with, then you're doing better to not put that principal towards the house. If you want I'm going to do an interesting little number for you guys. If you want to pay off your mortgage in 15 years, the difference in payment, if you were to do a 30-year note and pay it off in 15 years, or do a 15-year note and pay it off in 15 years, is not that much. And let me pull up some numbers here.
Yeah, absolutely.
So let's say you have a $200,000 home, and you know what? We are about to come up on a break, so I'm going to crunch some numbers for you guys, and I will touch back on this after the break. And so you're listening to 1250 WTMA, the Big Talker, and this is Mortgage Matters with Bill Sandvig, and we're going to touch back on when we get back from the break, so stay tuned.
Bill Sandvig has more Mortgage Matters straight ahead on 1250 WTMA, the Big Talker.
1250 WTMA.
This is Mortgage Matters on 1250 WTMA. From Movement Mortgage, here's Bill Sandvig.
Welcome back, Charleston. This is Bill Sandvig on WTMA 1250, the Big Talker. If you have any questions, please call in 556-1250. And if you have any questions for me, you can reach me up at my number, 843-300-7870, or my website, lowcountrylending.com. It looks like we have a caller here. Carl in Somerville. Are you there?
Yes.
Hey, Carl. How can I help you today?
Yeah, I'm a landlord and got a couple of properties. They're under the like conventional mortgages, and seem to be difficult to get refinancing on those type of mortgages. Any advice? And of course, I'm like 10 years, 15 years into the loan. So, and I have like a 6 and a 7% interest rate on those mortgages.
Sure. So I'd be happy to talk with you one-on-one about your specific situation. And but to general answer to that question, some of the problems that you might run into and some of the problems that people run into when they're trying to refinance investment properties is that the loan-to-value limits on refinances and investment properties are much lower than a primary residence. Also, the rental history that you might have according to that property could impact the ability for qualifying on a debt-to-income ratio. The most common thing that I see for landlords is the qualifying income on tax returns doesn't necessarily reflect the actual income that they're earning. And so if the properties that you own end up being close to a wash, then that's going to reflect on your tax returns and in turn make it more challenging for you to qualify for a mortgage. That's a common challenge for landlords. It's a common challenge for self-employed people. Is there's a difference between actual income and qualifying income when it comes to a mortgage. So I don't know what your specific situation is, and I'm definitely more than happy to talk with you about it one-on-one. But that might be some of the things you're running into. Does that sound familiar?
Yes.
Yeah. Okay. Well, please feel free. Give me a call after the show, and I got your number here as well, and I'll reach out. And thank you so much, Carl, for calling in.
All right. Thank you.
And looks like we've got another caller here, a good friend of mine, Brian Beatty of the Brian Beatty Real Estate Show. You there, Brian?
I'm here.
Hey, Brian. How you doing today?
Doing well, thanks. Congratulations on the new show.
Thank you very much. Thanks for calling in. I really appreciate it. Brian is a good friend of mine and a partner of mine, and I wanted to ask you, Brian, how are things going in the real estate market? Give me a snapshot. I know I heard your show this morning, and I'd like to just kind of get your 2 cents.
Sure. I was looking at an interesting statistic, which I think is a good testament to where we are as a market. And over the past few months, I've had almost a dozen listings that I've taken that have sold either before they were actually entered into the MLS or sold within the first few days.
Wow.
Close to 12 of them, and I've had several dozen that have sold in 30 days or less. And so if you take that and you kind of apply that to the market in general, with the understanding that every area, every neighborhood, every street is a little bit different, that really is kind of a good idea of what people can expect when they're entering into the process of buying or selling a house.
Yeah.
People that price their homes correctly and that are in good condition, with a good, solid marketing plan and a listing agent that knows what they're doing, should be able to sell that house in the first 30 days.
Yeah.
And if you're a buyer, you need to have the understanding that you need to have a very crystal clear idea of what you're looking for, because once it pops up, if that property is priced well and it's in good condition, you better believe that someone else is also interested in that property.
Yeah, I don't know.
It's very challenging for buyers to make quick decisions.
Yeah. I don't know how many clients I've shared that exact advice to recently, because I'm hearing stories from other real estate agents. I'll be in town next month. Here's the 12 houses that I want to look at. And, they don't grasp that these 12 houses aren't going to be there when you come downtown. We're going to look at that housing list the day before you get into town, and that's when we're going to make our showing list. It's just too hot right now. And really, really great testament, to Brian's network and to his influence and to the amount of people that he has at his disposal as far as being able to sell houses before they hit the MLS. That's why you want to use a partner like Brian, because when you're trying to sell a house, it is your advantage if you can get that house sold before it hits the MLS, because there's less time, there's less stress, and definitely a testament to Brian. If you ever want to reach out to Brian, have any questions for him, you can find him on his website, listingsincharleston.com. And Brian, what's a good number to reach you?
My personal phone number is 843-345-1273.
Brian, thanks so much for calling. Anything else you wanted to share?
No, just good luck. Enjoy the show so far, and I'm sure we'll be talking more.
All right, Brian, thanks so much for calling in. I appreciate it.
You betcha. Take care.
All right, bye-bye. So right before we left the last break, I want to touch back. We talked about the power of actually having a mortgage right now, how that money is really cheap. And Nick really quickly said the difference between a 15 and a 30-year mortgage. And I wanted to talk about how I have been advising people to get away from 15-year mortgages and stick with these 30-year mortgages because of interest rates being so low.
Right.
And I want to share, if right now with the average mortgage rate on a $200,000 loan, if you were to do a 15-year note, you'd be looking at a principal and interest payment of around $1,390. Okay, $1,390. Now, if you were to do a 30-year mortgage with the average mortgage rate, you're looking at a payment of $925. So we're looking at almost a $500 difference in tying up your money. When you do that 15-year note, you have to make that payment.
Right.
You have no choice. When you do a longer term mortgage, you could have a choice now. If you want to put additional principal towards your house, you can. If you don't want to because something unexpected comes up, you don't have to. Now here's the real interesting thing. If you take today's average 30-year rate and you were to amortize that and over 15 years, so you put together a plan to do a 30-year mortgage, but I want to pay it off in 15 years. Well, the difference, that payment would be about $1,450. That's only less than $60 more than if you had done a 15-year mortgage. Both houses would get paid off in the same time, but it's only a $60 difference. Now, if you can do anything better than get a 4% return on that $500, you're doing better by not taking a 15-year mortgage.
And Bill, the other thing you need to think about is you need to build contingency plans into all of your decisions. You don't know what's going to happen in 5, 10, and 15 years. You may lose your job. Bad things happen, right? Things happen all the time. And there may be a situation where you need to, even though you're on track to pay off that 30-year note in 15 years, you may need to readjust your plans. Child gets sick, whatever. And so the fact that you have a fallback plan, right? And you can drop your payment $500 in that scenario or whatever it is huge because life happens and things come up, right? And so you need to think about worst case scenarios whenever you're making a major decision like that.
Yeah, 6 years from now, you're perfectly on that, pay off that 30-year mortgage and 15-year track. Everything is going great. You have no other credit card debts to focus that money towards, and you're paying off your house. And then inflation kicks in. And like we talked about earlier in the show, and CDs are suddenly getting 8%, 9%.
Right.
And your savings account is giving you 7%. Well, would it make sense to keep putting $500 a month into your below 4% mortgage when you could put that money in your savings account and get a better return?
Right.
Of course not. We don't know what's going to happen. I'm not saying that's going to happen, but I'm talking about maintaining options.
Well, in the interest rate environment right now is unique, right? I don't know we've ever seen anything quite like this. And when you look at the difference in interest rates between a 15 and a 30-year option, the spread is not significant enough to where you really should move you to that 15-year option unless you're really passionate about it, right? And in the scenario you just looked at, I mean, $60 a month isn't a huge sum of money. And so when you're looking at that, you really need to look at not only could you put your money elsewhere to make more money, but also you need to make sure you think about, hey, worst case scenario, what might happen in the future? Could something come up where I would need to reduce my payment?
Right.
Just think about all those different contingencies when you make that decision.
Well, after we're about to go into another break, and after we do get back, we're going to talk a little bit more with Nick about what about after the mortgage. So we talked a little bit about while you have the mortgage, what to do with that money. Now, what do you do after the mortgage? What are some things you need to think about, some things that Nick deals with on a daily basis? This is Mortgage Matters on 1250 WTMA, The Big Talker, and I'm Bill Sandvig, your host, and look forward to hearing you after the break.
Mortgage Matters continues next on Charleston's Big Talker, WTMA. Now, let's get back to Mortgage Matters on the Big Talker. From Movement Mortgage, here's Bill Sandvig.
If you have any questions at all about mortgages, finance, insurance, real estate, please call in at 843-556-1250. I'm Bill Sandvig, and you can reach me at 843-300-7870 or find me online at lowcountrylending.com. We're here with Nick Pavia, and we're here to answer any questions you might have about mortgages, finance, investments, real estate, all that kind of stuff. And so I want to turn the floor over to you a little bit, Nick. We've talked about why you want a mortgage,
right?
And if you're out there, and unless you're loaded in cash and just making cash purchases, then you probably either have one or you're thinking about getting a mortgage because you want to make a purchase. Well, what about after the mortgage? Where do you step in? Where can you help consumers after that mortgage happens?
Yeah, most of the time when folks approach us, they've already made that first big purchase, right? So they're in that first home, and so they realize that life's changed a little bit, and that maybe they've made some sacrifices, maybe liquidated some holdings in order to get into that home, or done some things, right? And so what you need to do once the dust is settled and you're in your new home and you've been there a couple months, and you need to really reevaluate your full financial plan, right? And financial planning doesn't need to be very complex. A lot of times people overcomplicate it, but basically you want to find out a couple things. You want to make sure you're still on track to hit your goals beyond the house, right? Retirement, kids' college, etc. You want to make sure that you're still on track to avoid the things you want to avoid, right? Obviously, we all have fears financially, and we want to make sure that that home purchase is not pushing us into, sort of a red zone or something like that.
Being house poor, basically.
House poor, yeah, exactly right. And then, the third thing is that you want to make sure that, hey, you want to evaluate if you're on track to hit your goals, and you have to ask yourself, hey, am I on track? And do I know that I'm on track, right? And if you're not sure, or you're not 100% sure, then you really want to get in touch with your financial advisor and rerun all your numbers, right? And at the very least, there's a couple things you want to make sure you check off your list when you get into that new home, right? The first thing you want to do is reevaluate all your insurance, life insurance, disability insurance, your property and casualty. Make sure you talk to your agent, and make sure all of your policies align with that new home purchase. Typically, expenses are a little bit higher than they were before sometimes. And so you want to make sure that everything's in line with the way it should be. That's number one. At the very least, do that. Number two, you want to make sure you're still on track for retirement. A lot of times, folks, in order to get into a home, have to make a sacrifice. They have to liquidate maybe an investment account. They may have to borrow some money from family, whatever it may be, right? And so you want to reevaluate, hey, am I still tracking towards all of my goals? Investment-wise, kids' college, right? That's not going away, right? Retirement's not going away. We can't take a loan out for retirement. And so you want to make sure you're still tracking to hit your goals, okay? And then number three, you make sure you want to reevaluate your estate planning. I can't tell you the amount of times when clients have come into our office and we sit down with them and we look at their estate planning, which hasn't been looked at in 10 or 15 years. And maybe they have their first wife on as beneficiary or something like that.
Right.
And so, at the very least, you want to make sure you update your beneficiary designations and then make sure you tweak all your estate planning, right, to be in line with that new home purchase. Some of the basics you want to knock out: make sure you have a will, right? Make sure you have a testamentary trust for your kids. Healthcare power of attorney. And I'm not an attorney, but part of working with the financial advisor is, hey, let's make sure that all the different pieces of your financial puzzle are in line, right?
So I have a question for you.
Sure.
For many people out there in the Low Country, they're thinking financial advisor, that I'm not there. I might never be there. That's where I feel like I need a financial advisor.
Right.
Answer that question. I don't need a financial advisor.
Right. Well, I would say that a lot of times folks think they don't need a financial advisor when they really do. I would say that anytime that you need help around making sure you're on track to hit your retirement goal, you should sit down with someone or do the evaluation yourself if you feel comfortable with that, right? And we work with clients in a couple of different capacities. It doesn't need to be a real complex situation for us to add value. I have a lot of clients who get married, have their first kid, and they say, "Hey, Nick, I need some life insurance.
Right.
My dad said I need to buy some. It's the right thing to do. Can you help me?" Sure. It's an easy transaction. We can help you with that. That's number one. The second thing is sometimes folks leave a position, right? And they take a new job and they have an old 401k that's hanging out there. I met someone the other day who had an old 401k with a previous employer. She hadn't looked at it in 21 years. Right. It had 125k in it and she hadn't looked at it in 21 years. And I was like, "Why didn't you leave?" She's like, "I just it was out there hanging out and I haven't paid any attention to it." And so, that's a lot of money. Maybe need some TLC, right? And we can help you roll those dollars over, invest in. The third way we bring value is doing full financial planning, right? And that's where clients pay us a fee to do a full plan. And not everybody engages on that level, but that's the type of situation where we have a client that wants to make sure they're going to hit their goals. And that's really the only way that we can be absolutely 100% positive is if we gather all your information and put it together in a full plan to make sure you're tracking to hit your goals. A lot of times folks think they're on track, but when we run the numbers, they're way off.
Right.
And you sometimes it's easy to lull yourself into a false sense of security around finances. I've been doing certain things a certain way for 10, 15 years. And really there's some ticking time bombs in there that you need to pay attention to, And so a lot of times the fixes are pretty easy in nature. And I will tell you, the sooner you get it done, the better, right? When I have to tell a client that they need a reduced lifestyle in order to hit a financial goal, how many times do you think they actually wind up doing it?
Right. I
Never.
don't think I would.
Right. No one ever does. And so, obviously I know everybody listening to this show right now isn't, in the beginning stages of their financial lives, but if you are, think about yourselves 10, 15, 20 years down the line, right? Putting a plan together, like I said, doesn't need to be complex. I mean, if you want to take the time out and do all the research, you can do it yourself. But most folks, even I have my financial plan and I do it for a living, tested by another financial advisor in my firm. Yep. Right? To make sure I'm on track.
Yeah. So real quick final question for you is, I'm a first-time home buyer. I'm a young couple and not a lot of extra money to go around. What are the 1, 2, or 3 things that I should do first? I just bought my house.
Just bought your house. If you're a young couple, just had maybe that first child, right? Number one, you want to make sure you have some, just at the very least, some cheap term life insurance.
Term life insurance.
Just to protect each other.
Got it.
I'm not going to advocate, one type of policy, but just have something in place to protect each other.
Okay.
Number two, make sure you have a will in place and make sure if you have this, if you're starting a family, make sure you name a guardian, right?
Right.
In the state of South Carolina, they just line your family up and pick someone if you don't have someone named.
Okay.
So, take that next step. And the third thing is make sure you think about, being that you bought some life insurance, if something happens to the two of you, who's going to control that money for the benefit of the child, right?
Okay.
And so those are just some steps. And then the third thing is very easy. Make sure you're on track to hit your retirement goals, etc.
Well, Nick, thank you so much for coming on the show. It was a real pleasure addressing everybody today. If you have any questions for me after the show, you can reach me at 843-300-7870 or www.lowcountrylending.com. And this has been Mortgage Matters with your host, Bill Sandvig of Movement Mortgage. And thanks so much for listening. I guess we queued out just a couple seconds early there, and but it has been a real pleasure. And please, if you have any questions at all, give me a call, and I'll be happy to address any and all of them. We've been listening to 1250 WTMA, the Big Talker, and have a great weekend, everybody. Enjoy the weather out there, and we will be back here next week. Thank you so much.
You've been listening to Mortgage Matters with Bill Sandvig from Movement Mortgage. Call Bill for your mortgage needs at 843-300-7870. That's 843-300-7870. Listen again next week at this time for another edition of Mortgage Matters with Bill Sandvig on 1250 WTMA.